The funds that I send back home, I used to pay for my sister's education. I have a sick mom, and my dad is getting old, so that's a lot of responsibility to me as well.
COVID-19 has shown us that Colombians abroad could experience economic difficulties, but they continue sending money to their families in Colombia to help them.
Thank you all. We are still having people joining, but we will nevertheless start with the proceedings today. So, Excellencies, ladies and gentlemen, colleagues and friends, good morning, good afternoon, and good evening to all of you around the world, and welcome to the fourth and last session of the Global Forum on Remittances, Investment and Development. For those that are joining for the first time, I am Pedro de Vasconcelos, manager of the financing facility for remittances here at the International Fund for Agriculture Development, and I will be your host and moderator for the next session. For many people involved in the remittances and development arena, the topic of enabling environment in the remittance market might seem as a complex, different, and sometimes mysterious one, residing in different stratas of the global discussion on the cross-border payment agenda. However, while it might seem that way at times, it is not so. And indeed, an enabling environment and the regulations that englobe actually the 2 billion transactions made by migrants each year contain the main pillars of what makes, at least at IFAD, we believe, remittances for development work. And if I may add as well, there also requires to make remittances count even more. This has been made extremely clear over the last year, as many, particularly at the international community, which interacted and exchanges on measures that could mitigate the impact of this pandemic to 1 million people involved in either sending or receiving remittances. At IFAD, we surely witnessed this through the Remittances Community Task Force that we had the privilege to launch and lead jointly with our colleagues from the World Bank and the African Union in response to the call for solidarity from the United Nations Secretary General. Jointly with 41 stakeholders from the public and private sector, we understood the required and needed symbiosis between regulatory issues on the one hand, and on the other, the reality of migrants and their families home receiving remittances. Indeed, just to name a few of these key ramifications, the linkages of remittances with financial inclusion through services such as credit, savings, insurance, and pensions, so crucial to promote resilience in times of crisis, require an adapted enabling environment around these flows. And so does digitalization, obviously, as we've seen over the last year, and where we've witnessed the uptake by millions of migrants over the last year. Overall, this is probably one of the most important aspects for governments, regulators, and development practitioners to fully understand and embrace the reality of 1 billion people. Ladies and gentlemen, in 2009, under the Italian presidency, the G8 leaders adopted the 5x5 target to reduce the global cost of sending international remittances. Since then, the G20 leaders, and particularly through its Global Partnership for Financial Inclusion stream, took on this agenda, and early this year, through the Italian presidency and Russia co-chairmanship, and a more complete picture has been taken into account. And this picture now includes both the sending and the receiving side, or the realities that constitute the flow of more than 2 billion transactions a year that, if aggregated, correspond to an amount greater of ODA and FDI combined. And this is for the first time. So in light of this reality, and to open this session, it is my honor and privilege to introduce to you Piero Cipolloni. He's the Deputy Director General of the Bank of Italy and GPFI co-chair of the G2021 presidency. Mr. Cipolloni, without further ado, I would like to give you the floor to deliver your remarks.
Thank you. And I would like to thank the Global Forum on Remittances, Investment and Development for inviting me to join this Summit 2021. The Italian presidency of the G20 greatly values the commitment of all relevant stakeholders to the search of solutions for cheaper, faster, safer, and more inclusive transfers of remittances. The sending of remittances by migrants workers to relatives in their home countries represent a vital financial service. The last decade has witnessed a substantial increase in this type of cross-border flows to low and middle-income countries. As a large trend of literature has clearly highlighted that it has a very strong development impact, which spans several different dimensions: economic growth, poverty reduction, labor supply, health, entrepreneurship, human capital, financial development, and financial inclusion. Remittances now have become the most significant consumption smoothing mechanism for recipient household, as well as an increasingly important component of the global social protection system. These sorts of external funds has also withstood the outbreak of COVID-19, at least at the global level. As many of the speakers yesterday have underlined, in 2020, remittances flows stood at $540 billion, just 1.6% less than the year earlier. For comparisons, it might help to recall that the decline registered as a result of the global financial crisis was 4.5%. As a consequence, as Pedro just said, remittances flows are larger than the sum of foreign direct investment in and official development assistance to low and middle income countries. Therefore, supporting remittances by reducing transaction costs while ensuring an overall basic quality of this financial service is crucial and has always been at the core of the international development agenda. In my view, the G20 roadmap for enhancing cross-border payments, including remittances, represent an important step forward in this direction. It is a very ambitious project and complex initiative that will engage the international community for several years to come. Faster, cheaper, more transparent, and more accessible cross-border payments capable of leveraging the opportunities offered by digital innovation are expected to bring about significant benefits in terms of economic development and financial inclusion. I guess this is one of the topics that will be discussed in the next session. In this regard, a first key step has recently been accomplished. The Financial Stability Board, as many of you know, has just proposed a set of global targets for improvement, not only in terms of costs, but also of speed, transparency, and access. These are all important factors that should be taken into account in evaluating payment efficiency. The FSB is now seeking feedback from private sector operators on whether and to what extent these targets are achievable and how progress can be currently measured going forward. In the document, remittances are regarded as a separate category from other retail P2P payments in recognition of the greater challenges and frictions that some payment corridors in the market still face. Specific targets for this kind of cross-border payments have been identified. Now let me say something about what Italy did in this field. I am proud to say that Italy has always been at the forefront in strengthening the role of the remittances as a crucial tool for development of receiving countries and for the immigrants for the integration of immigrant community at the national level. As Pedro just reminded us, Italy was one of the original promoters of the effort to reduce the global average cost of remittances. In 2009, the Italian presidency of the G8 launched the 5x5 initiative with the objective of halving the cost of transferring remittances from 10 to 5% in 5 years. Italy was also
I believe we have a technical problem.
year the contemporaneous.
Yes, I think.
I do believe
yes.
a glitch is always expected in a virtual event, unfortunately.
Can you hear me?
Now we can.
Sorry about this.
You're good to go. We're gonna putting back the video.
Okay, I was saying that
There you go. Perfect.
Okay, sorry about this. In the content year, the contemporaneous presidency of the G20 and the co-chairmanship of the Global Partnership for Financial Inclusion have further reinvigorated Italy's long-term commitment with a number of important initiative plans. Let me say something about those initiatives. First, the forthcoming secondary plenary meeting of the GFRID on the 24th and 25th of June we launched the workshop on remittances in times of crisis and beyond. It will helpfully provide an update picture of the impact of the pandemic crisis on remittances, on the effective approaches implemented in both originating and receiving countries to support the flows of these flows and to preserve their beneficial impact. And finally, on the emerging of effective solution to the long-standing challenges that still are present in the market. A second initiative that we are undertaking will be dedicated to renew the focus on upgrading the national remittance plans that were introduced in 2015 under the Turkish presidency of the G20. In this regard, the GFRID has called for several lines of action, including the need for updating content and information in order to make the NRPs more useful and to craft adequate support measures for the short to long run. Finally, a standalone report will provide an in-depth analysis of the challenges faced by both migrants and their family back home during the pandemic, as well as of the priority adopted by the G20 governments and remittance receiving countries in order to improve resilience to external shocks. The emerging lesson and the best practice will be presented to the G20 leaders in October, the final meeting of the Italian presidency of the G20. As an emerging best practice, Italy might offer the recent revitalization of the table on remittances as a national stakeholder network comprising the public sector, the main market operators, the relevant trade association and civil society organization. The table contributes to identify public and private measures a strategy to smooth transmission of remittances through the formal financial system, including low cost and innovative financial services specifically tailored to migrants' needs. Let me conclude by reiterating that preserving the role and the importance of remittances for both sender and receiving countries through an appropriate enabling environment is more imperative than ever, as should be the national and international commitment to reach this goal. The breadth and the topic of the speaker at this summit 2021 demonstrate that a concerted commitment by all various stakeholders, private sector, public authorities, and international organizations, is the most effective strategy to keep the flow of remittances alive and to maximize its development impact on receiving family. Thank you all for your time, and I wish you a very productive meeting. Thank you.
Thank you, Mr. Cipollone, for your kind words and to highlight also the work that Italy has been done. My apologies if we had a technical glitch. It might be due to the electricity in the air after the game yesterday that Italy won. But we really want to thank you for this, and we look forward a week from now for the meeting to be hosted by the Italian presidency on the GPFI on this issue. So thank you so much. I think you're muted. There you go.
Bye-bye. Thank you again. And
thank you.
Good afternoon to all bad.
Thank you. So it is now my pleasure to introduce you to the next panel, Market Realities and Global Priorities, Ensuring Recovery and Resilience for 1 billion people. And to advance this understanding, dialogue around it, and more importantly, the implementation of those priorities, we have put together this panel that is part of an ongoing process involving numerous actions, as you might have heard, and particularly through the work of the World Bank, IFAD, FSB, FATF. So several actions happening. So let me introduce you briefly to our distinguished guests and panelists. We will start with my good friend Oya Pinar Ardik. She's the Senior Financial Sector Specialist at the Payment System Development Group of the World Bank. She will share with us cross-border payment through transaction accounts, pathway to financial inclusion. We will then continue our engagement with Louis de Cocker, Professor of Law at La Trobe University, and address the challenges of de-riskings in times of crisis and bring it under the new light as to the hidden costs or its hidden costs. We will call then upon Kieran Murphy, member of the Secretariat of the Financial Stability Board, better known as FSB, who will share with us the global roadmap for improvement on cross-border payments. And finally, we will ask Robin Newman, head of the policy analysis at the Global Alliance for Financial Inclusion, also known as AFI, to share with us the latest on applying risk-based approach to the last mile on remittances, particularly in terms of KYC and CDD or customer due diligence. Please note before we start that this session will include simultaneous translation, and will also be, if you want to ask questions, please put them in the chat. This will be directed to the panelists. Please know that if time does not permit, as we have seen in the past, and if we cannot address them all, we will post them on the GFRID website under this section. So without further ado, I would like us to invite the panelists to the screen. I will ask kindly the Secretariat to put it. There you go. And I will then give the floor to Oya for the first intervention. Oya, the floor is all yours. Thank you so much.
Thank you very much, Pedro. It's a great pleasure for me to speak here today and representing the World Bank. Obviously, the day is the International Day for Family Remittances is very important for us to once again understand the difficulties remittance families have been facing for a while, and to think about potential solutions as to how we can improve their stance in terms of sending and receiving much needed funds to improve their lives. basically, I would like to obviously thank you for organizing this panel and also this forum in general, because in essence, the work doesn't stop obviously after these forums, but it is a mechanism to bring us all together to think about all these issues collectively and to discuss the most recent developments. So this is very important for us to actually put together our thoughts. So today, as you mentioned, Pedro, I will be talking about remittances through transaction accounts and how they can be used as a gateway for financial inclusion. So this has been our work at the World Bank for a while, and we have eventually in 2016 worked together with the Committee for Payments and Market Infrastructures to draft the so-called the PAFI report, the Payment Aspects of Financial Inclusion report, where these ideas were, affirmed in a sense. I'll get to that in a minute, but first of all, I'd like to consider the question, why do we care for remittances? I mean, all of us are here, and obviously, next slide, please. Obviously, we all care for remittances, but just to put into perspective yet one more time, we know that they're all costly, and we know that there are all these targets out there. There have been out there for a good while. But in essence, the big reason why we have been trying to reduce the cost of remittances is that remittances matter more than aid and more than foreign direct investment in many low and middle income countries. In fact, all of them except China. So essentially, this is really quite big, a quite big issue right now, especially under the current situation coming out of COVID and so on. So in addition, remittances often serve as a gateway to the formal, the regulated financial sector. How so? Well, usually remittance families, both on the sending side as the migrant workers or on the receiving side as the receiving families. We know that they're usually the poor ones, and they are not necessarily, financially literate. They're not necessarily they do not necessarily own accounts. They do not necessarily do financial transactions using regulated methods. So when they would like to send and receive money, this is the one way in which they get introduced to the regulated financial sector. And it is important for us, therefore, working in financial inclusion, to think about ways in which how we can make them stick, make them stay with the regulated financial sector, to see how we can expand their opportunities. But at the same time, we know that remittances by nature, it's a very complicated transaction because it involves different jurisdictions, it involves different payment infrastructures to interact, it involves multiple service providers in the picture, there's less transparency, there's less competition, and so on. And with users being less literate, financially literate than potentially other financial service users, remittance costs have become an issue that the international community wanted to take a look at. And we know that these costs come out of the pockets of the remittance families directly. So this relates to their incomes overall and poverty and also income inequality reduction, right? So all of these basically bring remittance to the forefront of the development agenda. Next slide, please. So as I mentioned before, so we worked with the Committee for Payments and Market Infrastructures to develop this framework. And remittances fit in this framework very nicely. So the idea of this framework is to think about how we can improve the usage, the ownership and usage of transaction accounts. Now, transaction accounts are accounts at regulated financial institutions, which can be used to safely store money and to make payments. So this is essentially a tool for digitalization of remittances. Now, in this particular framework, we have many ideas outlined in this, what we call the house chart, but essentially it is very straightforward. It just says that we need an enabling environment, and this enabling environment needs committed policymakers, committed private sector actors. It requires a sound legal and regulatory framework. It requires good financial and ICT infrastructures. These all combined should be also linked to good product design that fits the needs of the users, a large penetration of access points, financial and digital literacy of the users are also important. And then the last bucket where we fit the remittances, but the remittances are essentially affected by everything else, is that for the purposes of financial inclusion, this framework suggests that existing recurrent payments can be leveraged. Remittances is basically an example of such payments, because they happen all the time. They are recurrent payments, and that's an opportunity for us, as I was saying, to basically reach out to these users with the right products, with the access points, with the literacy, with the right enabling environment, and to bring them in. Next slide, please. Now, why is it important for us to digitalize remittances? So this is something that we started publishing very recently as part of the Remittance Prices Worldwide database. We basically started splitting cash-based services and what we termed as digital services separately, and we have the average price for both. So as you see here, the blue line is the trend in the average price of digital remittance services, and they are much cheaper than the global average that we have always been reporting, and they're definitely much cheaper than the cash-based services, which are shown by the orange line. Next slide, please. So one other important point that I want to make, I want to demonstrate rather with data, is this slide here. So essentially this slide says that financial inclusion and cost reduction are related. And how so? So account ownership from Global Findex data is on the horizontal axis here. And the percentage point change in average cost of sending $200 from Q1 of 2020 to Q1 of 2021, so 1 year average change in the average cost, is on the vertical axis. And as you see that, basically for those, for basically the cost reduction is higher for countries that have larger account ownership. Now, obviously, we need to do a little bit more analysis here. This is basically just a chart showing the relationship between these two variables. But essentially, we can potentially dig deeper into this and see how we can make use of this result. Next slide, please. So this is another example from data that I wanted to share. So this is based on, again, our Remittance Prices Worldwide database. We started looking into this cash versus digital remittance services in a little bit more detail in the past year. And especially with the COVID-19 related lockdowns, we also started looking at service availability. Now, RPW does not necessarily cover every single service that is out there, but it aims to cover 80 to 85% of the remittances market in total. So here, but overall, what this chart should tell us is that the number of digital services are on the rise, and the number of cash-based services have started declining recently, potentially due to complications related to COVID-19 lockdowns, but that has to be, of course, confirmed as being a reason. Okay, so next slide, please. So I just wanted to put together here some of the things that the World Bank is doing in the area of remittances jointly with our partners. So we provide obviously technical assistance and lending. That's the regular stuff that we're doing. We're also doing targeted financial inclusion programs, which include remittances as components. We work on assessments of the markets for international remittances. We work on improving payment infrastructure, legal regulatory frameworks. We work on building strategic approaches to retail payments, including remittances. We have global engagements, including working with the G20 and the standard setting bodies. Some of this you have already been exposed to with the previous speakers. And we have this Project Greenback approach, which I would like to talk a little bit further, because I think this is something that that we work with migrants and receivers home in terms of improving their digital and financial literacy in terms of understanding how better product design can be done, and also thinking of informed policies. Next slide, please. So the idea of Project Greenback is to basically work in a country. It can be a receiving country, it could be a sending country, and have a bottom-up approach of thinking about remittances by choosing what we call a champion city. And within the city, we work with, if the country is the sending country, specific sending groups. If it's a receiving country, we work with receiving families. And what we try to do is to, through focus groups and detailed interviews, we try to understand their needs in terms of products, in terms of their awareness and literacy needs. And we try to also work with the service providers to actually develop these products, develop the literacy programs. We work with the regulators at the same time to ensure such products fit the regulated market, and also they encourage the literacy efforts and so on. So the whole point is to promote coordination, but to start small at the same time and bring the learnings up scale at a national level later on. So we have been working on this approach for years now, and we have done at least 12 country cases so far. And we have started sharing some of this information on our Remittance Prices Worldwide data website. So I'm happy to discuss more if needed. And basically, this is, I guess, the main point that I wanted to make today. So transaction accounts can be used as a gateway for financial inclusion. Thank you very much.
Thank you so much, Oya. Indeed, I mean, to be honest, it seems like we're hammering, the same message over and over the years, but it's needed because, it is basically needed because we still see the potential in the market for that. And I think, as I try to say at the beginning, sometimes it looks like there's two universes here that need to come together in the potential of what's happening in the cross-border payments world, and link it again with what remittance families live on a daily basis. Thank you so much for making those linkages as well with cost and digitalization. It is, as reiterated or as mentioned yesterday, we also seeing the same trade. So thank you so much. And that leads me to also I wanted to mention on the cost, as you put it very well. Cost is an indicator for us. It is not the finality in a way. It might have been. We do have an SDG target in that regard, but it's just an indicator if we're going in the right directions, I think. And this you highlighted pretty well. And that leads me to the next panelist, Louis Cocker, because we often talk about the cost, and 99.99% of the people, when we say remittance costs, they will just think about what it costs basically to send us remittances. But there's also many other costs behind that. And when we sadly enough been been proven right during the last year and a half with the measures that there is still vulnerabilities out there. There's still issues that exist. The one like de-risking and understanding the realities of 1 million people is so crucial, because for a migrant that needs to send money back home, telling them that you need to do it formally or informally doesn't matter. At least it wouldn't matter for me if I need to send money to my mother. I know that my money is clean, and I know that I need to support my loved one, and I will find any other way to send it. And if this is not cataloged or recorded in the national accounts, what do I care? So my point is, this will still happen, and the de-risking phenomenon that we've been talking now for many years, it is still something that we've seen during this type of crisis, where the closing of corresponding bank accounts for very valid reasons sometimes, and not valid or still is an issue. So we, in this dilemma, we asked Louis de Cocker, who I believe is the person in the planet that can simplify it, can try to enlighten us a bit more into how to address and what we expect in this topic in the future in terms of the real costs of remittances in its totality. So Louis de Cocker, you have a very challenging question, but I believe you're the only one that can really enlighten us on this. So you have the floor, please.
Pedro, thank you very much. It is indeed challenging, but it's great to have not only this panel of experts, but this group of people gathered, and the leadership displayed by IFAD over so many years, and the standard setting bodies to work towards answers. Now, I do have a few slides that may be helpful to get up, but while we're waiting for them, the issue that I have to address has two parts to it. Next slide, please. Firstly, de-risking, and I just want to very quickly unpack de-risking and then move to the main question: who pays the costs? Next slide, please. Now, de-risking is a very general term, referring to any step taken to lessen your risk, and that in general is good, but it's attained a very specific position and challenging position in relation to remittances and also financial inclusion. Oya has put out very well the important and positive case of digital financial inclusion. But that requires people to have access to the financial system. And while great work has been done to increase access to financial services, we've been faced for the past years, around since 2013, with early movements already around 2004, 2005, with de-risking in the form of de-banking, or plainly put, denial of financial services, where banks have decided either to cease doing business with other banks, correspondent banks, especially in regions where that influences the remittance channel, or where banks decide not to bank any longer, not to provide any service to money service businesses providing cold-face remittance services to senders and receivers. Now, the reasons for this is complex. At the heart of it lies concern by big banks about money laundering and terror financing risk, because their regulatory risk and their regulatory fines have been increasing due to lapses in the proper management of money laundering and terror financing risk in general, not only in respect of remittances, and often not in respect of remittances at all, but their general concern elevated their concern about all risk, and that has had a particular negative impact on remittance channels. But the reasons are more complex. We've seen changes in business models since the global financial crisis. We've seen responses to Basel standards around risk and capitalization. And as a result, there's a collection of reasons centered around the standards of the Financial Action Task Force and the standards of the Basel Committee on Banking Supervision that has brought about, together with commercial reality, the problem that we face at the moment. Next slide, please. So the question is, how does this impact and who is impacted? And I want to lift out 3 specific participants in the process: the sending and receiving committees, money service businesses, and society. And instead of simply speaking about the problem or showing statistics, I thought I want to bring you voices from these affected communities, which we collected during a study on remittance communities linked to the Horn of Africa in Melbourne to try to understand the impact on them. Next slide, please. Firstly, sending and receiving committees. Now, the names that I'm using here are all pseudonyms, but they would hopefully provide you with a sense of how the community responded. Ella, for instance, lifted out that the closure of the remittance shop, the small business that served her and her community, will change people's lives, saying in Somalia, there is war. Some children have been orphaned. To them, the $100 that I can send means a lot. The communities, often refugee communities in the safety of Australia, are very, very well aware of the risks faced by their family members back home. And they feel a deep need to support them. Dawood, for instance, said, even though I have no money, I have to send. I ask other people in my community here or in Queensland, I borrow money to help. We have to. And I think you need to sense the desperation and the conviction in that statement. Or Jaya pointing out the lack of alternatives. I'm not going to mention the name, but a US headquartered global remitter, said Ujala, doesn't live in the remote area. They don't have a shop front where my family lives. It can take 2 days for our people to walk to the city. And then they can't interact with the people because they don't speak English. They don't know English. And the fee is higher. Or Kabira asking in desperation and exasperated, how is sending $150 to your mother terrorism? So sending communities and receiving communities has been affected, but also been alienated by decisions taken by banks that have not been communicated to them. But the general comment from all was, despite this, we will make a plan. The money will flow because we have no choice, as you pointed out, Pedro. Next slide. What was also surprising was the impact on money service businesses. Now, the money service businesses that service these communities have been established by people from the refugee communities, often leaders, often part of the first wave coming over, often people who identified the need and started to build a business from scratch, having never been in this business, but because they were trusted, they built a business. They are community leaders. People look up to them. They employ people from the community. They provide jobs. They are registered in Australia with AUSTRAC, which is the AML-CFT register or regulator. Dara said, the Australian government gives us a license. We report weekly to AUSTRAC. All of our systems are certified. External auditors check our services. With the Australian government, we are fine, but the banks say, you are too risky for us. Lots of money is being spent on trying to be credible for banks, and the banks don't respond to that. Badra, people who've gradually built their lives after fleeing war and trauma, are now being cut down. The shops literally in front of our eyes were being closed down in the mall where we were having these interviews. My connection to my country of birth, my parents, my grandparents, has been cut off. Rahad, and they all send money, but they also provide these services to their community. I'm worried not only for the business, but I don't know how my mother, my brothers, my sisters will live. It's very painful. Next slide, please. Another glitch. It's clear all of the formatting on the slides have been affected, but I hope you can read some of these views. So what's happened? The payments were driven into cash and underground. We interviewed one specific remitter, Bars. This was a year later. At that stage, the remaining remitters were all operating in cash. They were still licensed for AML purposes, but they didn't have bank accounts. And they were couriering cash as a group out, 500,000 at a pop through a cash courier, declaring that at the airport. The community was very hard struck by it, angry, feeling it was put in place without consultation. One saying, for me, it's another form of colonialism. No one explains the rules to them. No one engages with them. They just learned that their business has been shut down because decisions were taken. And interestingly enough, the Australian Competition Commission has highlighted competition concerns, expressing concern that banks may be perceived to be closing these relationships to preserve market share rather than necessarily to manage risk. Next slide, please. So COVID impact, Oya has pointed out some of the impact. We know people have lost jobs. We know it's impacted on the amount to be sent looking at the World Bank data. But in Australia, the borders were closed. So that immediately impacted on cash couriering. No rebanking took place at any great scale. Those who lost accounts did not gain their accounts. No debanking occurred. And we've picked up, for example, that some have worked together and have actually been using trade-based financing in very clever schemes to move value when they can't move cash. All of this means a lot of the movement of value has gone underground, which is totally counterproductive from an AML CFT perspective. Next slide, please. Right, just to wrap up, there are good news and some not so good news. Good news, the Financial Action Task Force that sets money laundering and terror financing standards have launched a project looking at the unintended consequences of these standards, and part of that includes looking at de-risking. And we're really hoping for some action to come from that. For the past years, they've called on banks not to engage in this conduct, and that unfortunately has not had any positive effect. So we really hope that more positive impact will come from this project. But the good news is also balanced by some not so good news, because FATF has also increased its compliance obligations, broadening the need to perform risk assessments to proliferation financing linked to sanctions against Iran and North Korea. And that will have a global impact. And all banks will have to review all of their relationships. And we are concerned that, again, they will look at the remaining money service businesses and be concerned that their measures to combat proliferation financing risk is not strong enough, and that may lead to another wave of de-risking. Thank you, ladies and gentlemen. Thank you, Pedro. Let's close on that note.
Thank you really so much, Louis, for this. You know, as you know, we always say at IFAD, remittances are the human face of globalization, and you brought the humanity back, particularly with this subject. Thank you also for sharing the flags. some red, some green. But you're absolutely right in our engagement with the effects of de-risking. This really needs to take into account, and this is no news. It didn't happen just recently. My first acquaintance with that was after the September 11 events, having seen that the only money transfer company sending money to Somalia to hundreds of thousands of families being shut from one day to another, and families basically had an entire month to try to find another way. The informality that was created that day still continues today. It's very difficult then to go back. So thank you so much for highlighting this. As for IFAD, this is of course of maximum importance because we know that half of the flows go to rural areas, and all the issues that you've presented is actually the realities that many face every day. So thank you so much on this. But there is indeed some hope if we come together with the full picture, I believe, to present, and that allows us to work. And that leads me then to also our next guest speaker, Kieran Murphy from the FSB, in relation to cross-border payments, and to share with us the roadmap and the improvements that are foreseen in this respect. So Kieran, again, it's a pleasure to have you here today, and I will give you the floor, the 10 minutes for your presentation. Thank you so much.
Thank you. I presume my presentation is going to come up now in a second. Great, thank you very much. So this is my first time presenting at one of these summits, and it's very interesting because of the roadmap is obviously broader than remittances, and we'll see this as we go through the slide. So it's very interesting to hear the interest and the passion around financial inclusion and encouraging the improvements in this regard. And our wish would be that this roadmap will be a game changer, really, when it comes to the issues that are faced on cross-border payments and remittances specifically, because of the holistic nature of the roadmap. And I'll go into that in a second. If we go on to the next slide. So basically, in the past, the FSB has been involved in some of the topics that have been mentioned already, in particular, efforts to address the decline in correspondent banking relationships and to improve remittance firms' access to payment services, which is something of key importance, I think, and would be a big benefit when it comes to, in particular, costs. So the latest initiative that we have is this G20, this FSB roadmap for enhancing cross-border payments, which was published in October last year and was endorsed by the G20. So it has the endorsement at the very highest levels. And it aims to go further by addressing these issues in a comprehensive way, because in the past, it's generally been the case, for example, with the UN Sustainable Development Goals, you're looking at cost and isolation. The roadmap will look at a huge variety of aspects. So when we look at cross-border payments right now, these are the 4 areas that we see as being the major challenges that we need to address, which is high cost, low speed, limited access, and insufficient transparency. And these challenges affect end users and service providers, but they don't affect them all in the same way, which is something that the 2 previous speakers have put so eloquently. That in particular, individuals and small companies face challenges with retail cross-border, and it's not just a question of cost and speed, but of financial inclusion. And in particular, low-value payments can incur relatively high fees and very cumbersome processes, and they can be extremely slow, as already been examples have already been given of this. And unbanked and individuals and firms from fragile states, and particularly in rural areas, may not be able to access payment services at all. So if we go on to the next slide. Thank you. So this is I don't think the source is down here, but basically this is the roadmap. This is taken from, the roadmap was produced in 3 stages. And this is from the stage 2 roadmap produced by the CPMI. So if you look up the cross-border payment stage 2 roadmap, you'll find this. And it goes through in detail each one of these building blocks. But basically you can see that there's 5 focus areas. You have this public and private sector commitment vision that's there, because this is not something that can be done by either the private or public sector in isolation. It has to be done together. You have steps to coordinate regulatory, supervisory, and oversight frameworks. You have improvement in existing payment infrastructures and arrangements. Then you have data quality and straight-through processing, because this is clearly a big problem, particularly when it comes to remittances, in relation to digital IDs and so on. And then the fifth is a bit more forward-looking. So this is looking at new arrangements that could exist in the future, like central bank digital currencies. So each of these so you have 19 building blocks there in total, and each one of them has 3 to 5 actions that are set out in detail in the document. And this includes basically the kind of dates that we would hope to achieve these by as well. So it's a very comprehensive roadmap. And in particular, when we're looking at remittances, for example, some of these areas are of particular importance. For example, building blocks 2 and 4, which look at a regulatory supervisory framework. So essentially it's looking at implementation monitoring, how existing international standards are implemented and the gaps and areas for alignment of those, which is particularly concerned when it comes to AML CFT. For example, that's not being implemented the same way in different jurisdictions, and this is cost implications and other issues, access issues as well. You also have building block 5, which is looking at applying AML CFT consistently and comprehensively and having harmonization in that sense. And this is being led by our good colleagues at FATF. You have promoting safe payment corridors from the IMF and the World Bank, which is a very important as well. And in terms of the technical aspects, I would think that the getting direct access to payment systems particularly for non-banks is quite important, because it certainly speeds up the process because you're directly entering into the payment system, and it is also much cheaper to do that as well, rather than going through a bank or a correspondent bank who will charge you for that. So these are the areas that I would see of most significance just looking through. Naturally, we don't know what the impact of CBDC will be on remittances or of new multilateral platforms, and this is something more for the future. But you can see that this is a very holistic roadmap, and it's covering a huge amount of topics, being led by it's led by the FSB, and in the sense that we will be monitoring the progress of it. But you have various international organizations involved as well, and various standard setting bodies. If you move on to the next slide, please. So one of the first tasks onto the roadmap that was mentioned by Pierre Cabaloni in the introduction is this publication of the consultation report and the proposed targets, which is the idea of setting a vision and kind of basically a level of ambition for the roadmap, create accountability, and provide a commitment mechanism to drive change. So you can see that the public consultation was launched on the 31st of May. If you look up the cross-border payments roadmap in the FSB, if you Google it, you'll find it. And the idea is that you would have, again, endorsement at the very highest level for these targets in the G20 Leaders Summit in October this year. There will be yearly reports from 2022 onwards on the progress against key performance indicators, because this is something that we will need to develop as well. The idea is not just to have these targets, but be able to monitor the progress against them and to see how improvements are being made over time. Then the proposed targets themselves, there's 9 of them in total. They're simple, high level, smaller number, and focused on the experiences of end users. And they've been set at the global level rather than a national level, but it could be the case that when it comes to the monitoring progress, there will be regional progress looked at as well. Something to bear in mind when it comes to the end users is that we're talking about the ultimate payer and receiver of funds. So that can be an individual, it could be a business, it could be a public sector entity, and it could be a financial institution. And you can see that we're looking at, thank you for setting it there, looking at wholesale, retail, which includes business to business, person to business, and so on. And as also mentioned in the introduction, other person to person payments are included here, separated from remittances. And then you have the third segment being remittances. So we've set targets across all 3 of those segments, which for the purposes of this presentation, I'm only going to concentrate on the remittances target. Can you go to the next slide, please? So we have defined, as you would expect, that remittances segment, but it's important to have these definitions in the report itself for clarity so that everybody knows what we're talking about. As being low value, high volume transfers of money between individuals, typically to family and friends abroad, and these can be recurring, so regular basis, or non-recurring one-off payment. The major service providers are, as you'd expect, the international money transfer operators, commercial banks, the post offices, and mobile money operators. And we want to emphasize again, which was also mentioned in the introduction, about this separation of other P2P to reflect the fact that there's considered to be different priorities of the end users and greater challenges involved and faced by some of the remittance country corridors. And we've given examples in the report of other P2Ps being like a person paying another person for something sold on an online platform, such as an auction site, or basically sending money, for example, to a musician directly for a performance that they've seen online. So there is a bit of a challenge there to see if this separation is clear, and do people agree with it, and is there sufficient differences to distinguish between the two? Because if we are looking at, again, with the measuring of these targets in mind, is the data there to separate and distinguish between other person-to-person payments and remittances? So this is, I just want to highlight one of these questions on the consultation that we would welcome your responses to. Next slide, please. So these are the targets that we have initially proposed for the feedback of the public in the consultation and from concerned parties. For the costs, we felt that the UN Sustainable Development Goal is very well known now. It's been mentioned by the two presenters before me as well. So this is something that is always reiterated, and we figured that this was something that is not yet been achieved, and it would show a consistency of ambition to retain it. And this is a global average cost, no more than 2%, no corridors higher than 5%, and this is by 2030, which is again UN SDG goal. For the other three challenges, we have set a date of end 2027. This is with the roadmap actions in mind. So basically, the consideration is that a lot of the actions that have been already agreed under the roadmap are for around 2024, 2025. So we have set a more, say, a cautious date after that of end 2027, bearing in mind that the roadmap could change over time as there are new developments. So for the speed, one of the reasons for this is from the data from the World Bank that about 50% of service providers are already processing payments in less than an hour, and we acknowledge that that is service providers, not payment volume, but it's still a very useful figure to have, and that we would look at 75% within 1 hour of payment initiation. And we have defined payment initiation as being when the payment order is received by the payer's payment service provider. So it's very important to know when the clock starts, particularly when it comes to remittances. And for the remainder of the market, to allow for the fact that there may be some, for whatever reason, slower participants, then within 1 business day is taken there. For access, basically we looked at the global Findex database, which has been already mentioned, that roughly 63% of people in developing countries have access to a transaction account. And this is again something that's been mentioned already in the session, is the lack of presence in the formal financial system that creates additional challenges, particularly when it comes to customer identification. So the basic aim is to allow the vast majority of those who want to send and receive remittances, including those that don't have access to a bank account, to make cross-border payments for legal purposes via services that conduct proper AML CFT checks. And then for transparency, we have set a common target across all 3 segments, and that is that for payment service providers to provide a minimum defined list of information. So the idea is to create basically a floor of transparency across the market, and while at the same time avoiding unintended consequences such as increased costs due to having to source and provide this data. If you go to the next slide, please. Thank you. So we have 11 questions. We want to hear from you. Are the targets measurable? Are they feasible? Are they realistic? Some of the questions are a bit more generic, as in, do you agree with the 3 segments? Others are very targeted and specific, such as the question I mentioned earlier on comparing other P2P to remittances payments. And also there's a question I'm sure that a lot of people will be considering in their responses of the 2027 date for that. Is that realistic? Is that feasible? Could it be even more ambitious and be in 2026? These are questions we've asked, and the deadline for responses is the 16th of July, as given here. And just to finish up, also in mind with some of the specific examples given, that when we're working on these kind of topics, it can seem a bit abstract and a bit distant from people, and sometimes there's a lot of technical terms, and it's not exactly a riveting read sometimes with these reports. But I was talking to a colleague of mine about this, and about particularly the remittances target, and she mentioned to me about the issues that she faced sending money home to sub-Saharan Africa, and that it was costly, that it was unreliable, it wasn't very predictable in terms of when the recipient would receive the funds, and these kind of issues, particularly in terms of lack of options as well. And my response to her was, this is what we are trying to fix in this roadmap. This is, we are trying to reduce the costs, we are trying to give more options to people, and we're trying, particularly in terms of the transparency, to give people a bit of assurance as to when the recipient will receive the funds as well, and obviously access speaks for itself. So this, while the roadmap may seem a bit, it's a large document. There's a lot of moving parts to it, and it's going to take a huge effort on behalf of everybody involved to get these targets over the line. But they really do have the potential to make a real and positive difference to people around the world. And while it is a broader roadmap than just remittances, the remittances segment is something we are very conscious of, that it could have a very real impact on people's lives around the world. So thank you very much for your time.
Thank you so much, Kieran, for this. We have already shared in the chat. There's some questions that are coming, and we will ask each participant, since I see that we are running out of time, if they will kindly take the time to answer them, so we can post. There's a lot of requests for the information for the publications. We will be sharing all this, so do not worry about that. So thank you so much for showcasing this, and particularly showcasing that remittances are part of course, another several processes, and I think this is very good, and on the targets as well, and the feedback that you would like to also to receive. We can see also how the participants here can provide also their feedback on that. So thank you so much. I want now to go to our last participant. Robin Newman is the head of policy analysis of Alliance for Financial Inclusion Global. Robin, I know that financial inclusion is in your DNA, and this is why you come at this particular moment. You guys with GFRID last year, and the height of the pandemic, released a toolkit that we are also going to share, with your permission, within this chat. We believe at IFAD it was a key document, because as compliance requirements exist, we need to find ways of addressing them. It's a reality, and this toolkit is very important in this, and the work that AFI has done. I want to take this opportunity to say that at IFAD, we launched a $1.6 million initiative that operationalized the remittance access and innovation, and that basically takes is founded on the findings of this toolkit, this inclusive financial integrity toolkit. And with GFRID, we are aiming at a total of 14 remittance service providers across 7 countries in Africa to be capacitated on customer due diligence and know your customer innovations, with the goal, hopefully, that by 2023, 4% of RSPs, low income and rural customers, will face reduced barriers and accessing remittances, as suggested in this toolkit. So not only we wanted to commend AFI and GFRID for this, but I would like to give you the floor, so if you can expand more on those findings, and I will give you, of course, the time. Even though we're running late, I'll give you all the time that you need, the 10 minutes. So Robin, you have the floor. Thank you so much for being here.
Thank you so much, Pedro, and to all the organizing team for the invitation to be here, and even more importantly, for your support in seeing the toolkit implemented in practice. It's my second appearance here in the Global Forum, so I'm really delighted to be back amongst individuals and organizations that are doing so much inspiring work to push the needle on remittances and migration, and all of that work is absolutely complementary to our mission in AFI of financial inclusion. I do have a few slides, so if those could be displayed, that would be great. Thank you. We can go straight on to the next slide, please. And even the next slide. Thank you. So just to say a few words of context, as I know we do have a diverse audience at the forum. AFI is a Global South network representing central banks, ministries of finance, other financial regulators. We have 100 or so member institutions from almost 90 countries, which collectively contain around 80% of the world's unbanked population. We work with our members to push forward on their financial inclusion goals, supporting them through peer learning, capacity building, and critically in-country implementation as well. And ultimately, we're looking to influence policy changes that will make a tangible difference to the most disadvantaged and low-income segments of society. Next slide, please. So just say a few words here about the relationship that we observe between the policy objectives of remittances, financial inclusion, and also AML-CFT as a third dimension. We've heard already in earlier presentations that remittances can really be a key gateway to financial inclusion, as well as other objectives such as women's economic empowerment. But that is much more the case where they're done digitally and funds can be retained in that digital ecosystem. Where cash-based remittances persist, it's much more difficult to leverage those for financial inclusion gains. But we also see that becoming problematic from a money laundering and terrorist financing risk perspective, because it's difficult to monitor those funds that stay in the informal economy. So all three of these policy objectives really have a shared goal, and all of them will benefit by the digital transformation of financial services. But in practice, unfortunately, we can find that frictions do occur between the different policy objectives in practice, where the goals and even where some of the processes are not synchronized as well as they might be. So it's really a case of not just two universes that need to come together, but I think three universes when you add in the AML-CFT dimension as well. And next slide, please. To dig a little deeper into some of the challenges that exist in aligning AML-CFT and financial inclusion. To its credit, the standard setter for money laundering and terrorist financing rules, the FATF, has long recognized the complementarity of these objectives, and it has provided a framework by which conceptually they can align, and that is the risk-based approach. And the risk-based approach requires enhanced due diligence to be applied in cases of high money laundering or terrorist financing risk, but also critically, it allows simplified measures, flexibilities to be applied in cases of assessed lower risk, which is particularly relevant in a financial inclusion context, looking at rural communities or microfinance products, for example. Unfortunately, we find that in practice, the risk-based approach is not implemented as successfully or as consistently, especially across low-income jurisdictions, as we might hope. And one of the reasons for that is that although these goals are complementary at the system level, when you look at individual incentives for each actor, they don't really favor much of a focus on low risk and applying proportionality. When we throw into the mix coordination challenges, challenges in capacity for risk assessment, and the overall complexity of the money laundering terrorist financing environment, all of this can unfortunately result in unintended consequences for financial inclusion. As we'll see on the next slide, please, we have one data point to evidence this. So this is data from the World Bank Findex, which shows that of the unbanked population, what proportion of those cite ID and verification challenges as the key barrier to their inclusion in the system. And you can see that in a number of countries, including Philippines and Zimbabwe, more than 40% of the unbanked population are excluded because of ID and verification challenges. And the figure's around 30% in a number of other jurisdictions. So all of this means there's several 100 million of the most vulnerable in our societies who are excluded from the system because we just haven't got this ID and verification challenge right. We haven't implemented the risk-based approach successfully in all cases. Next slide, please. And it's worth emphasizing as well that this impact of lack of flexibility in money laundering and terrorist financing measures, it really can have a disproportionate effect on women's inclusion. Women are often less likely to hold the kind of documents like passports, utility bills, proof of address, and so on, that are not actually required by FATF, but are unfortunately often required by individual financial institutions as part of their compliance measures. And that's one of the reasons we still see this persistent 9% financial inclusion gender gap in many developing countries. Next slide, please. So how can we fix this? How can we try and address these points of friction between financial inclusion and AML-CFT so that low-income populations can be onboarded into the system, and so that they can undertake digital remittances as well? Well, over the last couple of years, we have been working together with Senfree, as Pedro mentioned, to develop the concept of inclusive financial integrity, which just refers to the alignment of financial inclusion and AML-CFT goals and processes, starting from defining a common vision of success. And more importantly, we've developed the Inclusive Financial Integrity Toolkit, which looks to provide practical guidance and codify and capture best practices from countries around the world, how policymakers can look and achieve this alignment in practice. Next slide, please. So the toolkit starts from the approach of mapping all of the key processes in the AML-CFT value chain, and then looking through each process to see how can financial inclusion goals really be integrated into each step. So we start off by looking at upstream processes, national strategies and policy making, and how we can define a common vision there. But the toolkit also has chapters looking at regulation and supervision, and finally looking at downstream actions by individual financial institutions and how the alignment can really be achieved in practice at that level. The toolkit also has a significant focus on the key multi-stakeholder national processes, including national risk assessments that really provide a key underpinning. They give the justification for applying flexibility in certain low-risk contexts, and also in the mutual evaluation processes as well, by which countries are rated on the technical compliance and the effectiveness of their money laundering and terrorist financing measures. So each of these processes need financial inclusion actors involved and financial inclusion considerations to be embedded. Next slide, please. The toolkit also goes into some detail on some of the key challenges that are currently encountered in country-level implementation. That includes customer due diligence processes, where recommendations are provided, including use of biometrics and particular measures that may be considered for the inclusion of disadvantaged or vulnerable groups, such as women, migrants, forcibly displaced persons as well. The toolkit looks at supervision and how to shift from a rules-based culture, which can really be a challenge from an inclusion perspective, to the real risk-based supervision that may achieve better outcomes, both for the objectives of MLTF, but also financial inclusion as well. And the toolkit also gives significant coverage to data challenges and how they may be effectively overcome through multi-stakeholder coordination, and also looking at leveraging RegTech and SoupTech solutions that can lead to better informed risk assessment and policy implementation as a result. And next slide, please. The toolkit contains a lot of country examples. That was really a priority for us to base it on peer learning. Here are just a couple of the ones to highlight here. Bangladesh, for example, has done a lot to issue specific guidelines on a risk-based approach to mobile money, which is now also a key channel for remittances as well. And also issued specific simplified KYC for low-income rural women, as well as publishing a risk-based supervision manual. South Africa critically removed the requirement for proof of address as part of its move to a principles-based, risk-based approach. We're seeing that trend across sub-Saharan Africa now, and that's helping to remove what was really one of the key impediments that's not actually required by FATF, but just had become a commonplace compliance requirement by financial institutions. And then finally, Costa Rica has also introduced simplified due diligence for entry-level accounts with basic functionality. The next slide, please. Coming towards the end of the presentation, I'd just like to say a little bit about the trends we're seeing now around digital identity and the move towards eKYC, both of which have really been catalyzed by the COVID-19 pandemic, which has required remote onboarding of customers, critically to receive emergency funds from governments, but also to conduct daily transactions as well in the context of lockdowns and movement restrictions. We've seen numerous jurisdictions enact digital ID programs and eKYC regulations during this period. We're now capturing a lot of those in a policy model that will be published later this year. Jordan, I mentioned in the last bullet point, is one very good example where we saw emergency measures coming in to reduce KYC on mobile wallets. And now Jordan is in the process of rolling out a full national EID scheme that will allow all citizens, but also refugees in the country as well to onboard to financial services digitally. FATF has definitely lent its support to this process, which has been helpful through its guidance on digital ID and subsequent call by the FATF president to make full use of such solutions for enhancing compliance. So there is a real hope that the transition to digital identity for client onboarding could actually be one of the silver linings that comes out of the pandemic's cloud, if you like. And going on to, I think, the final slide, please. Thank you. So just a few takeaways to summarize some of the main points from the presentation. As we've seen, financial inclusion, remittances, and AML-CFT really are all complementary goals. More of one does not mean less of the other. It's quite the reverse, but we have to get these practical challenges right, which do unfortunately persist when it comes to the country level application of global standards. As Louis mentioned, the FATF project on unintended consequences does provide a good signal that there's a genuine will from all parties to achieve a better balance in this regard. Tools and resources such as the Integrity Toolkit are certainly available to support policymakers, regulators, and supervisors in this journey. And as they look to implement these measures, they should give significant focus to disadvantaged groups such as women and forcibly displaced persons, so that we really have a human-centered approach to dealing with these issues that understands the human cost of exclusion as well. De-risking, as Louis covered, remains a concern in many regions, but there is hope that greater interregulator coordination and technological innovation can offer some opportunities to reverse the trend here. And finally, we do see the catalytic digital transformation impact of COVID-19. Yes, there are risks from new technologies in terms of digital financial literacy, data protection, and cybersecurity, but a real opportunity as well to get a more effective alignment of AML, CFT, and financial inclusion, really bring down the cost of client onboarding, and through that pathway facilitate greater uptake of digital remittances as well. So this, I would suggest, should be a real priority for all policymakers committed to financial inclusion and remittance goals going forward. I'll conclude my presentation there. Thanks very much, and I'm more than happy to take any questions.
Thank you. Thank you so much, Robert, for this. And I'm going to tweet some of the things that you just put in there. So much appreciated again for this. And once more, thank you for equipping us with this practical toolkit. We took the opportunity to share it within the chat as well. Ladies and gentlemen, there's a lot of questions. Louis, you have several for you, etc. The problem is we run out of time already by 15 minutes. So I don't want the panelists to, I already got like 3 lawsuits from the panelists after me. So I would like to avoid another one. So I will go directly to that. But as we promised, all the questions will go answered. So no question will go unanswered, and we'll kind of ask your collaboration for that. I want to thank you so much for for your participation today. This has been recorded. We will tweak the heck out of it and put it elsewhere, so you might see yourself also around social media. Thank you so much for your contribution today. Thank you. And with this, I would like to go for the second session today. Well, we'll try to address maybe one of the most expensive questions in the sector, as stated in the SDG 10C, what drives the cost of remittances? At IFAD, we've been working very hard to identify all the variables that constitute, I think, what we call this equation, as we like to call it in IFAD, the equation that can help us understand all the determinant of costs. There are diverse and variables according to the market environments. And therefore, I think it's very important to understand this better. And to help us bring this discussion to bear, we decided to bring you some of the key remittance gurus that exist in the world and the private sector practitioners to help us visualize this. So it's my pleasure to introduce one of those gurus that will have the pleasure to introduce the rest. He's no more than the very renowned remittance specialist in the field, Leon Isaac from DMA. So Leon, you have the floor. We will push your session a little bit more before we conclude it. So rest assured you will have the time for your discussions. Thank you so much, colleagues. You have the floor, Leon.
Thank you, Pedro, for that overly generous introduction. And I guess if we were all together, we'd be saying this is the last formal session and we're standing between you and the drinks reception afterwards. Unfortunately, we can't promise you that today, so you'll just have to put up with a very interactive session that I hope we're going to have. As Pedro said, what we're going to try and do now is look a little bit more into what's actually behind the cost of remittances. We continually hear about the cost. It has come up over the last 2 days. What's actually behind it? Why are some corridors more expensive than others, even if on the face of it, they look roughly the same? Why do some product types cost more than others? And then finally, we'll finish with, well, what could be possibly done about it? For a very brief bit of background, we heard earlier from the Banca d'Italia about 2009 and the L'Aquila summit when the 5x5 global target was set. We should remember at that time that the price of a remittance was estimated at just under 10%, and the goal was to get it down to 5% by 2014. Unfortunately, that proved harder than was anticipated, but prices did fall a little bit. And that goal was generally been taken up by other entities, particularly G20 summits, the Valletta Summit, and so on. And as we've heard, most notably in the Sustainable Development Goal 10.C, which says that by 2030, the cost of a remittance should on average not be more than 3%, and no single corridor should it be more than 5%. And this has been reinforced elsewhere. Now, we also know that remittances are a large volume of payments, 702 billion to all countries, and 540 billion to developing countries last year. We know that the cost was 6.38% in the first quarter of this year. So that means that to developing countries alone, the cost was $34 billion approximately, spent by senders to send money. So if the price was to drop to 3%, that would represent a saving of around about $18 billion, between 18 and 24 billion, in fact, on the amount spent. So hitting the Sustainable Development Goal would save us roughly $20 billion, which is why we have that as the title of this session. I think if we look at it another way, since between 2009 and the beginning of 2021, remittance prices have gone down 3.3%, about a third from the price they were 10 years ago. So we've got roughly the same amount to go to get there by 2030. So you could argue, well, let's do nothing and the trend will get us there anyway. I don't think any of us on this call would buy into that, but that's just to set the scene. So, and of course, the challenge with remittances are there are tens of thousands of corridors, and each one has a different set of circumstances and priorities. So what we're going to do now with this highly esteemed panel is to look at what are some of the explanations for the high cost, and then go on to what could be done about it. I'm going to start with Dr. Manuela Orozco in a minute, once I've introduced everyone else. Manuel, we saw you earlier this morning, so I hope you've managed to get some sleep between now and then, because it was about 4 o'clock in the morning then. And Manuel has been doing a lot of analysis on the reasons for why costs are what they are in the different corridors, and how we can look at that in a logical way. That's then going to be followed by 2 active practitioners. I'm delighted to say we have Malik Sek, who's based in Dakar in Senegal, who's the Managing Director for Africa for RIA Financial Services. So an entity that started off as a cash-to-cash business now offers multiple services to clients all over the world, and will have a good handle on some of the key cost areas there from both a receiving and a sending side. And then I'd like to say after that, we've got Dora Ziambra, who many of you know is the Chief Operations Officer at Azimo, one of the leading digital remittance companies. I would have said new players, but I think you're now into your 2nd decade at Azimo, so that's a bit redundant. So I am going to pass the floor to you in a sec, Manuel, but first of all, just to remind everyone that we do have translation, and also to send your Q&As. I imagine we'll be like many other sessions and might run out of time to actually answer them all live. We'll try and do what we can, and if not, answer them otherwise. So Manuel, over to you.
Thank you very much, and good afternoon, everyone. I didn't go to sleep, otherwise I will have stayed asleep. Thank you for the invitation, and let me point out to 3 main issues that I think can help frame this discussion of transaction cost, because it helps to distinguish and differentiate the normative from the market approach to transfer costs. I think in this context, we need to focus predominantly on the market issue of the transfer cost. And one of the premises I think I posit as an element of framing the discussion and the empirical issues of cost is that it has to be framed within an instrumental consideration of financial inclusion and financial integrity. And I was pleased to see the discussion in the previous panel precisely framing these issues on financial inclusion, precisely within the context of an equity framework. And I think when it comes to transfer costs of remittances, it's important to contextualize it on that element. Otherwise, you're left basically wondering, why do we focus on the transfer costs of remittance transfers and not on the expensive cost of paying rent or mortgages? Migrants, for example, pay relative to the broader market higher interest rates on mortgages and rents than the average person in the host country. So this is an important issue, I think, that we need to keep in mind when talking about cost. The second, and perhaps more specific to the issue, is that averaging the numbers and putting a benchmark without context perhaps is not very useful if we don't contextualize it within 2 broader elements. One, I think it has to do with the position in which countries are faced within the global context. There are at least 3 different structural elements that define a country's costliness, to use a broader term. One is economies of scale. We know, we have learned that very small countries where market transactions are less than 200,000 transfers per month are more likely to be expensive. The other factor, it's the nature of the institutional nature and makeup of the nation state. State fragility in particular shapes the costliness of a transfer. Countries that are going through conflict, civil wars, natural disasters, or natural resource poor countries, landlocked states, famine-affected countries, countries affected by climate change tend to exhibit higher transaction costs than others. Places where there are transnational organized crime networks operating tend to have expensive costs because of the due diligence performed with regards to compliance against financial crimes. Other elements have to do with militarized or authoritarian regimes, where it's difficult to enable the presence of foreign investment infrastructures so that you can have, let's say, less stringent transaction costs. So all other factors include the poorly performing economies, economies that have very low levels of economic complexity, where you have highly informal economies and highly dependent countries on external sectors on two factors. Let's say agricultural exports and tourism, and migration is the third one. Those are more likely to have expensive costs. So when we look at the list of countries, for example, that are significantly expensive, many of those countries fall within this first criteria of, the position in the global context, the structural position in the global context of different countries. So, we're talking about countries like Afghanistan, Somalia, Sudan, etc. Haiti, it's another example. So if some of these countries meet at least two of these criteria, it's a first level consideration as to the context in which cost needs to be addressed. Then you have the market-driven factors. Here you have elements that have to do specifically as to the risk factors that explain a transaction cost driven by the marketplace itself. They have to do, for example, with the size of the origin and destination networks, how small or large, how competitive they are. The marketplace for the local currency, it's another important element, which is somewhat connected to the global structure factors, but sometimes there is just a scarcity of foreign exchange in a given country, and that increases the cost. The scope of payment vehicles, how do you originate a transaction, also has an effect in your transaction cost. The number of participants in the market corridor is definitely a factor also explaining the cost. The quality of partners paying remittance transfers, whether it's a banking financial institution with very limited operation, 3 branches, no ATM access, no digital infrastructure available, or if it's a credit union that has a widespread presence across a country, but no digital offering. And then the market share concentration, it also tends to explain transaction cost. Oligopolistic markets tend to have a higher cost. So in here, what I have been trying to look at is the red flagging elements that can allow you to have like a traffic light detector, where you can, have a red flag or a red line pointing to specific risk factors that increase the cost at a given point in time based on a given benchmark. Your benchmark can be, for example, looking at those transaction costs that are 10% above or more expensive than the country's average in a given corridor. So these elements can help to really calibrate with more precision where the cost is a real problem, rather than looking at just the general benchmark of the 3%. Doesn't mean you set aside the 3%, but that these guidelines can help you to achieve with more precision, with more proportional response, the implications and the effort to make this transaction cost more affordable. So again, the 3 premises are really connected to one, to the issue of financial inclusion and financial integrity. That is, the cost transaction has to be embedded within this context of inclusion and integrity. You cannot risk exclusion or the issue of compliance. The second one is the distinction between the structural and the market-driven factors. And the third one is the application of certain benchmarks that can allow you to have red flag indicators of risk factors in order to improve with more precision and proportionality. Where are you looking at a particular context, the transaction cost? And I think, you know, that can help frame efforts in a more policy structured manner and way, the efforts on cost reduction. Thank you very much.
Great. Thank you, Manuel. I think you've covered a lot of ground in a short period of time. And I think I saw just in that time at least 17 different areas that have the potential to have a significant influence on cost. And I think what you've outlined gives us a good way of breaking things down into the different areas.
That's better than 17 questions.
Yeah, but also I think particularly useful for policymakers to help them understand why they may be seeing the prices that they are, and then to look at whether those conditions really are present or how they can be addressed. So thanks for that. What I'd like to do now, Malik, is come to you and maybe ask you to react a little bit to what Manuel said. But really what I'm very keen to understand is, what are the big cost challenges for you in being able to deliver a fast, efficient and affordable service to your customers who want to send their money home? So over to you.
Thank you very much, Isaac, and then thank you, IFAD, for this great initiative. Cost-driven is really a challenge for the whole industry. Looking at for Africa, for instance, the costs have been higher for a long time because of exclusive deals in the continent. As you know, money transfer remittance has been run in the US and other countries for more than a century, but in Africa, companies come to the continent only about 30 years ago. And for almost 20 years or 15 years, the market was shared by major companies signing exclusive contract with banks. Those are the ones only allowed in most countries in the continent to do business, because this is considered as a banking business. So during years, no other companies could get into this market, this growing and developing market. So the price was naturally very high, extremely high, and the consequences. One of the consequences was not only the price, but informal transfers. Also, the informal sectors were very, very highly developed. So a few years ago, some companies, local companies, started fighting against that situation, which was against the law, the local law in many countries. It was just a practice. Because what they did, those major companies, they just said to the bank, I can sign with you and with your competitors, but you could not sign with my competitors or any future competitors. Fortunately, new government in the continent understand the importance of remittance in many countries and set up laws through central bank or directive through central bank to remove those contracts. And then start, the price start getting down, a little bit down. Not that much in the continent because the network was not that important. Banking network was not that important. And in many countries, sub-agent network are not authorized. Until now, countries like Tunisia or other countries, banks are not allowed to have a sub-agent network. So the network is very limited, which doesn't help the price to get down. So secondly, we have as I said, the regulations. It's an ecosystem where banks, sub-agents, IMTOs, and agents at the same side need to earn something. And since only banks can sign, even though they have one location, they used to share the commission with the sub-agent, which also was another fight for new entrants like us in the continent in the beginning, where we succeed to convince bank to give at least 80% of commission to the sub-agent, because those ones are the ones spending their money, using their capital flow, paying the charge, the capex and the opex. So they deserved to have more commission than the banks. The bank was just kind of a sponsor, a legal sponsor of those important network, sub-agent network in the continent. So that's also did not help to get the price down. A limited network and the regulations with banks only to do that business. And then you have the whole compliance cost, kind of a customer service, upstream customer service. Companies need to have a higher compliance organization to do this business. And at the downstream side, a pretty important customer service department, because the network is there. We need to help, to support, to babysit the customer, the beneficiary, on a regular basis, on a daily basis, to let them identify the network, helping them to identify the network, helping them to understand, because most beneficiaries are not very educated, so you need to help them. Some companies even put someone at the banking hall to help them fill the form. All this doesn't help to get the price down. So many elements are participating in this continent to have a higher price. And until now, in many other corridors, as Manuel explained, the price is pretty acceptable, but in Africa is still very expensive. And furthermore, in most of those countries, some of those countries, about 20 of those countries out of 54, the rate is usually fixed, vis-a-vis euro or vis-a-vis dollars. So international companies do not have foreign exchange usually. They just gain on the commission, while in other corridors they have either commission and foreign exchange gain. So these are issues that hold the price until now up. However, COVID has driven the price a little bit down because it accelerates many digital projects. So sending to digital is developing in the continent. In many areas, international companies are setting partnership with MCOs to send money direct to digitals. And then the promotion also of bank deposit, because banks are considering bank deposit transfer as long-term resources. So usually they can even squeeze the commission, or in the contract, usually the commission are not that important for them. Which is an opportunity to get the price down at the sending side, because they consider that money as long-term resources. So a country like Nigeria, for instance, the government helped to impose bank deposit for every transfer. Every beneficiary for a long time should have a bank account to receive their money. So, which helped a lot to get down the price. Secondly, we have other policies, other public policies in some countries. If you consider what is called PRI, Pakistan, for instance, Remittance Initiative, which is sponsored by the Ministry of Finance in Pakistan, that help help the customers to pay nothing. Transfers are free, and the government pay back about $5.3 to the banks that give back the money to the MTOs who share it with the agent. So this is the policy which helped Pakistan to receive more money, a lot of money. Of course, the foreign exchange gain was still there, but the inflows has extremely developed in that country since they set up this policy in 2010, which is the PRI, Pakistan Remittance Initiative. Other countries also, like Bangladesh, the government set another policy to give back to the beneficiary, dollars for $1. Anytime they receive a transaction, $1, they have about 2% of the face value for the beneficiary. This is the other way around, helping the beneficiary to get the sending price in his pocket. So which was very, very successful. The inflow has extremely increased to that country because of that policy. There are also other countries like Sri Lanka who set up this kind of policy too, giving to the beneficiary 2 rupees for $1. Anytime they receive $1, they have 2 rupees, which help the customers and which help also customers, sending customers to use the formal way of sending money using the normal channel for the central bank to receive the hard currency required, etc. So those are some public policy that help to to remove the price as for PRI, or to help the beneficiary to get back the sending price. Currently, there is this kind of policy in Nigeria. For 1 naira for dollars. Trying to help those Nigerians sitting abroad to use the formal channel and then to be paid at the end at the lending side in dollars. This is for them a way to fight against informal businesses, those guys who are sending money through under the table. But it also we start seeing a little bit improvement in the numbers, at the lending side. So this is really an interesting debate, this pricing thing. But I believe that, as Manuel rightly said, it should be per corridor. The analysis should be done by corridor, depending on where you are sending, and depending also on from where you're sending, based on competition at that level, based on the network at that level, at the send side, and the network also at the sending side. So this is a never-ending for me, a never-ending game. That we will be, we are involved. We at RIA, we are committed to get the price down. We're not expensive, and we still keep work to get the price down, even though it's an ecosystem where all actors need to earn something. Thank you.
Great. Thank you, Malik, for that. I think you covered, again, a lot of territory, and I think you gave us some examples of why prices have been high. I think the exclusivity, which really leads to a lack of competition, that clearly came out. Regulation can have an unintended consequence, particularly if local partners that are non-banks or that are agents of banks are not permitted to offer. You talked about, I think key point was most of your answers implied physical distribution. So we're talking about cash-based products here, which is an inherently expensive model. And then some of the other areas, I think some of the examples you gave with PRI, a very long-term public policy area that's having positive impact. I guess the situation in Nigeria is somewhat different, and I'm not sure we've got there yet, but we're in the middle of certain changes anyway in the marketplace. Dora, I'm going to come to you. As I said, Asimo, you started off as I think a purely digital company. Now you're certainly digital on the send side and offer customers lots of choice on the receive side. So are the costs different for a digital company? And we've heard so much, I guess, in the last 15 months since COVID started about the potential for digital, which has been talked about for years, finally starting to be recognized at most levels. But even as we speak now, most transactions still involve cash somewhere. So can you explain a bit about your model and then how you see the big challenges on cost for you, and then we'll come to what we might be able to do about it.
Yes, absolutely. And thank you, Liam. It is really an honor and a privilege to be included in this panel and to also be celebrating International Day of Family Remittances with all of you, which was yesterday, as we all know. We are all aware of the resilience that the sector has shown in the midst of this global pandemic. And a short introduction, obviously, I'm, as Liam mentioned, I'm Dora. I am the CEO of Asimo. Asimo is a digital money transfer company sending primarily from Europe and the UK, but also most recently from Canada and Australia. And our vision has been to improve millions of people's lives by offering a better way to send money around the world. And by that, we mean cheaper, faster, and safer money transfers. This is no news to anyone. We're all working on the same goal, but we believe that our digital model is making inroads and getting us closer to that target. I'm going to take a little bit of a different approach than Malik and try to break down a little bit the cost that we see it on our side, not as elegantly as Manuel's equations, but essentially our cost of sales could be split in three, meaning the cost of getting the money into the system, the FX cost, and the payout cost. Asmo was founded in 2012, and hence we went straight on a digital model on the sending side, which means we do not have a physical network. This has allowed us, obviously, to offer consumers either a web or an app. 85% of our transactions at this point are sent via our app. What has this done is allow us to lower the cost, since we lack the physical and the maintenance of the agency network. On average, the cost of sending with Asimo is 90% cheaper than the commercial banks, and we charge an average of 2%. As I say, average, there's some corridors that are indeed much higher, and we know the structural issues with them. So this is the one part of the equation that we've changed. The effects rate, we personally and as a company don't see it as a huge cost driver compared to the getting the money in and out of the system. In most cases, we collect funds in major currencies, and even in exotic markets, there is hunger for US dollar in most cases. So the FX cost is probably a fraction of the total cost of the cost of sales. Lastly is the payout cost. The payout cost varies by delivery method. We offer cash pickup, mobile wallet, bank deposit. We do observe higher cost for cash pickup. Of course, cash is not going away anytime soon, but during COVID, we for sure observed a significant shift from cash pickup delivery method to bank deposit. Philippines is an interesting market, large remittance market. About 12 to 18 months ago, 25% of our transactions we're going to bank deposit. Now that percentage share is over 50%. Of course, there are local regulations that may help that. Malik outlined quite a few countries that are pushing for more, either for recipients to have bank accounts or open mobile wallets. So it's a combination of things that drives this change, but it's definitely easier for us to service it. So I stuck that into those elements of cost of sales for us as a digital player. A cost that is usually highlighted as quite high for especially fintechs and digital companies is cost per acquisition. I've always talked about the actual implied cost is the one of trust. A lot of people take some time to onboard into a digital product, and that cost is not really measured in dollars. At the same time, I'm pretty confident that the large offline players and incumbents have fairly large marketing budgets. So cost per acquisition is something that we manage quite actively, but I don't think it's different for each model. It is there. And I think this is how I would like to present what I see as the cost drivers within a business.
Yeah, which is great. So thanks for that, Dora. Maybe I could just come to you and ask about the area of compliance. And I guess, you know, Manuel obviously highlighted financial integrity and so on as well. And we heard from Louis very clearly on the de-risking area. And I guess they all come together. It's often said that money transfer operators have an increasing cost or have increasing costs around compliance. Is that your experience? And Malik, I'll ask you the same afterwards. And if so, can you help us quantify whether what sort of order of magnitude that might be?
I think it depends, because obviously we're all working as an industry for risk-based approach. So sending to one place is different than sending to another place. There are two opposing forces in this. From one point of view, being digital, using a lot of technology in our system allow us to scale compliance and lower the cost. At the same time, there's the other tension of regulators asking for more and more. So broadly, I don't believe the compliance costs necessarily have been going down. They should be going down, and we should have more coordination, especially, for example, when it comes to KYC or, you know, asking from one side, you get financial institutions asking for fields that are really not necessary and do not apply in some cases. And there's very little room for us to apply that famous risk-based approach. So technology has made compliance much easier to handle at scale. but still the rules are not applied as efficiently as we would like to.
Great, thanks. So I think that sort of implies they're still open to a lot of different interpretations. And I guess that's where the Send Free and AFI toolkit might come in with certain parties anyway. Malik, what's your experience with the compliance side of your business? How's it changed in the last few years?
Yeah, it has changed a lot because, as you know, we are a highly compliance, we have higher compliance standard. And as you know, at the same side, let's say in Europe or in the US, you do have specialized organizations that manage our sector. But in the continent, in Africa, it's the central bank who supervise this business. So we don't have a dedicated law or dedicated organization managing this business. So we have very low compliance standard at the banking side or at the post office side or the sub-agent side. And we do not accept, we as RIA, to deal with a non-compliance, even sub-agents. It had to be compliant. If there are some high standard in the country, we align. If not, we apply our own standard. So in our operating unit in Africa, as well as in Latin America, everywhere, we have a lot of, as staff, important staff, helping, the banks, helping post offices, helping sub-agents to align with our higher standard in terms of compliance. Because we expose, of course, we do not have a license at those areas, in many areas at the paying side, but we don't want to expose our brand, our reputation, and even our value in terms of compliance. So it's at that level, it's very, very costly. We have people managing transaction reviews on a daily basis, compliance analysts, helping training, even giving training session to sub-agent and even to the agents. In some areas, you have banks, and even with some banks are very compliant. Regional banks are extremely compliant, but you can see some standalone banks, individual bank, where we have to share our compliance standard and up to the sub-agent network. So we have a team in charge usually to travel within the continent, helping, training, sensitizing them on compliance. And as you know, beneficiaries or agents at the banks at the sub-agent level are not very high educated. So we need to educate them on how important this compliance is. So this, of course, is cost-driven at our level, not only at the send side, but also at the paying side, because we need to align in all countries where we're operating.
Perfect. Okay, thanks, Malik. So I think what I take from both of your answers there is that the compliance cost is an area we could look at to see how it can be streamlined, which would help lowering overall costs. Manuel, sorry, I've kept you in the back there, having gone first, but coming to you, and I'm going to give everybody a minute or two just to sum up, because I know time's beaten us. But Manuel, what the study you did, which looks great, as a great starting point. For everybody, I want your top 3 things or areas we need to look at if we're going to reduce costs. So Manuel, what would your top 3 be? You're on mute, I think, Manuel.
I knew that. I was just testing you.
Yeah.
Well, I think, look, we have followed this issue of transaction costs for over 25 years. And it's always a debatable issue. And IFAD has actually done an extraordinary work in following through this debate, promoting the dialogue and engaging the subject within the issues of the marketplace, particularly on aspects of competition in the industry. We did a study about 2 years ago looking at these issues, reviewing an entire set of the literature that dealt with this subject, trying to filter the normative from the empirical, starting with, the terminology itself. Is the cost is high, high relative to what? You know, one thing is, you know, it's to set the benchmark. So brings up all of these set of factors, and one critical factor that comes across definitely is the number of participants in the industry. One new factor that comes across is the presence of different payment vehicles, specifically, especially in the past 3 years, the so-called digital mechanism, the digital vehicle. You know, I'm old-fashioned. I used to refer to internet-based payments operations, but I have to go with the flow and talk about digital, which perhaps to some extent is more precise, but the digital is a second important factor. The more players are offering the digital vehicle, the offering of the pricing becomes a little bit lower than the cash-to-cash operation, and partly because your pricing structure is somewhat different. For example, yes, you have more compliance costs when you're doing digital because you have to pay engineers trained on compliance to exercise a lot of this work, as opposed to the compliance officer that is monitoring cash-to-cash transactions, applying the conventional KYC mechanisms. And so those are two very important issues. And the third one, apart from the technology, the digital component, and the number of players, is the economies of scale. And the economies of scale sometimes dovetails with infrastructure issues, you know, the informal condition. Those are more structural elements. In those countries where you have high informal networks, where your payment infrastructure is cash-based, you're creating structural restrictions as to the number of vehicles available. So those elements in the end correlate to higher transaction costs. So, you know, from a policy standpoint, you go back again to the fundamentals of financial inclusion and financial integrity. How do you improve the integrity components to make them more cost effective? Technology helps to some extent improving your benchmarks. You know, so some of the benchmarks, for example, of compliance that come from the Basel metrics, sometimes they are inaccurate, but banking institutions, regulators follow those metrics and give you higher penalties on regions, for example, on the African continent. And these are biased assumptions, but those biases actually have an effect on pricing in the industry.
Great. Thanks, Manuel. Really good 3 points. Dora, three key areas.
Of course, to no surprise, of course, for me, number one will be digital. And I don't only mean, again, I will reiterate, not only digital on the sending side of what Azima is doing, but how technology can help us automate a lot of these processes. And it ties in a little bit also to compliance. Manuel, I wouldn't necessarily agree that the cost of engineering is high compared to reviewing documents manually, just because one is more scalable than the other. Compliance team, Azima compliance team reports to me, so I'm fully aware of every field that we have to review and add every time someone downstream decides to do so. And all money transfer companies deal with it and suffer with it, and we all want to be compliant, and in many cases, unfairly so, are treated as though we're causing troubles into the financial system. The truth is that we're actually helping people sending money back home. So digital across the board into processes, onboarding, both on the sending and receive market, for me, is key in lowering the cost to the end customer. The second thing I wanted to mention, of course, is nothing new. People alluded to it, was interoperability and ecosystem. Having, for example, access to real-time payment systems, something that the FSB has also highlighted as a key goal. We have interesting examples with the UK, allowing non-banks accessing faster payments, PromptPay in Thailand, InstaPay in the Philippines. These allow for more digital payments that can also alleviate some of the compliance challenges we have by having more information digitally saved. And lastly, again, back back to this compliance point on having more coordination, Kieran's toolkit also highlighted the impact of financial inclusion. It's not about only the risk-based approach, but also thinking on the receive side, what is available? You may ask for a proof of address, but address is not available in every country the same way. And these things are, we should be doing everything we can to fight off money laundering, terrorist financing, but we also have to be smart of how this applies to people on the receive side.
Brilliant.
Those are my three.
That's great, Dora. I'm sorry, I'd love to listen to you for longer,
No,
but
no.
I think time's against us, but that was really clear. Malik, I'm going to have to limit you to a minute or so, I'm afraid, but anything else to add to what you've heard for those great solutions there? You're also on mute, I think.
Sorry. So just to add that, you know, like when you've been in this business, you know, a long time ago, as well as Manuel, but if you look at, you know, carefully, the business has not changed over the past few years. The engine is more performant. We used to use, you know, traditional engine before, fax, you know, big mainframe, and then computer, laptop, and now, what do you call it, mobile. These are the engine that have been used over the past few years, but realistically, the business did not really change. You have a cash in, even though the cash in can be automatized from your bank account or a physical cash in point, and then using the engine, sending it to a beneficiary. Even if the transaction comes to a mobile, you need to use this to buy something. So the actors are strictly the same. So nothing has particularly changed. So we in RIA, we are a multi-channel company. We can send from mobile, from an agent, from RIA.com, from, you know, for all those tools, and then pay out in the same way in all those tools, in digital, cash pickup, etc. And the strengths that we have is the network, because this business is a network business and a volume game business. I used to be with an MD of the most successful money business in Africa, who said that his success is not a technology success, it's a network success. Because even though you have digital, let's say digital sending network, you need to have a cash out at the end of the day, or how do you call it, someone that you can use your mobile banking, and all those guys need to earn something at the end of the day. So we at RIA, we promote the multi-channel business, which is that's what we're doing now. We are fintech. Some people consider us as traditional money transfer companies, but we are a fintech because we have a very performant platform, using that platform to make the exchanges from the send side to the lending side.
Perfect.
So
Okay.
not much has been changed. Yeah.
Not much has changed, but prices are going down, which is good.
Yeah,
I think time has beaten us. I'm sure Pedro is going to say that we'll answer all the questions that you've written in and so on. I think congratulations, Pedro, for financing Manuel's study work on that. I think it's really useful. I also think, you know, my conclusion from listening to this is there are a lot of different moving parts here.
But we were just getting started, unfortunately, especially with what Malik said at the end. I think that raises digital actually increases financial inclusion. So the network is bigger through digital.
But I think one of the clear outcomes to me is that we need to look and start categorizing corridors to see which ones are performing at lower cost, which ones are higher cost, and see what we can learn from those to really apply them to policy areas. I just want to abuse my position for 2 seconds just to say that we didn't talk even about the area of transparency, which is really important to people, because even if costs and prices go down, people don't always know it. And there's a real cause for companies to promote transparency. So just to say, we at DMA Global have made a pledge for the next year of IDFR to actually really help any company that wants to improve their transparency with any technical knowledge we can provide to them. It's on our website. Pedro, I'm going to hand back to you now. I'm not going to try and summarize what we've heard because I'm sure that will come up later, but just say congratulations to you and the team for being able to achieve so much in a non-physical environment this year. Hopefully we'll all be together for the next one in person, wherever it is. So many congratulations, and back to you.
Thank you so much, Leon, for this. And actually, I want to thank all the participants. We were more than 40 speakers and panelists over these last 2 days. So it's been fantastic. I don't know how to categorize these panels, which one is better. We are compiling right now all the takeaways and outputs. But it's been really fantastic. Last year, on the commemoration of the International Day of Family Remittances, we honor them. Today, also on the International Day to combat desertification, we had a panel with the diaspora investment in climate change, showcasing the tremendous role that they have. So really, I want to thank you, and particularly this panel, to bring this famous equation about what determines costs as we move forward to also support member states and private sector entities. Ladies and gentlemen, I'm actually saddened to reach this point where we need to close the forum. But I think it's a good point to take some takeaway messages and set place to reconvene next year on the needs that have been highlighted today. And that's why it is my great pleasure right now to invite Dominic Ziller, Vice President of the International Fund for Agriculture Development, who will try not only to englobe the key messages of this forum and give you some takeaway messages as well, as we say, as the part on our way for the next forum. So without further ado, Dominic, you do have the floor.
Thank you very much, Pedro. Excellencies, ladies and gentlemen, it's not the most grateful task to, at the end of 2 days of deliberations, say the final few words, and obviously nobody wants me to repeat all the meaningful things that have been said. Nor can you really sum up what, as you said, Pedro, more than 40 panelists have contributed. The good news is for me that over the past 2 days, all of you have underlined the importance of remittances. And what was a positive surprise for me this year to learn that during this dreadful COVID year that lies behind us, remittances have not really gone down. I'm not sure in how far I can really trust the figures, because there have always been informal remittances, people traveling and having money in their pockets. And now, as you couldn't travel, this has probably gone down a bit. And you have also recognized that the crisis has brought it with it that there are more formal remittances, because now people were forced to use the formal systems, which is in a way also good, because it helps us to garner additional information of what's really going on in the field. I think one of the key issues for the SDGs is remittances, not just because they reach so many people, they're involving more than 1 billion people across the globe, but also because of the volume of the remittances, much more than ODA and Southern Cooperation and Triangular Cooperation altogether. So to look at it through the lens of public, private, and civil society stakeholders, it was important to discuss the relevance of the remittances in times of crisis, and also how to use the remittances in a more productive way, in a more conducive way to sustainable development. The main challenge for the development community till 2030 will be that the 6.7 trillion US dollars in aggregate remittances that we expect till then can deliver a significant multiplier effect, improve livelihoods, strengthen resilience. How can we move away from consumptive use of remittances to more investive use? How can we generate more sustainable benefits? I want to underscore what President Ongbo said yesterday. Given better opportunities to save, remittance families will save more. Given appropriate investment options, remittance families will invest more. And given better mechanisms to invest in human capital, remittance families will live better lives. It's a bit easier said than done, and Gilbert knows that, so I'm allowed to say that, because those who need the money to buy the food that keeps them from starving will not necessarily agree that they can invest. And about 75% of the remittances are used to meet immediate needs. But that means that 25%, over 100 billion a year, are left for other purposes. So these others who receive this money that they don't need for feeding their children, for which they have more leeway to use in ways to do better, to become less dependent, they are the ones who have the best opportunities from these remittances. And for years, we have asked, how can we do that? For years, we have been looking for silver bullet solutions, the one-size-fits-all solution, just to realize that there is none. Let's admit it, we have not been stagnating, but we have also not progressed as much as we had aspired to in 2015 when we negotiated the Addis Agenda. For quite a while, we have rather failed to achieve a breakthrough and to come up with more convincing ideas. And yeah, we must recognize that while globally remittances are $1 billion business, for remittance receiving family, what counts is not the billions or trillions. At the human level, what matters is the $200 on average that they receive as monthly remittance. And that is where our attention needs to focus. This forum here was intense, it was productive, despite having these virtual sessions, which most of us are probably tired of now. More than 500 people have participated in the 4 sessions. And frankly, it feels a bit as if we are finally closing in on a breakthrough. Also because we have stopped focusing too much on reducing the costs of money transfer and instead have started to look into the needs of the potential startup entrepreneurs that can create their own businesses with the remittances. Therefore, my first takeaway of these sessions is the need to ensure the resilience of the 800 million people at the receiving end of remittances, where the development impact is greatest. The SDGs provide a unique opportunity to match the goals of remittance families with the enabling environment of the public sector, to also tap into the innovations of the private sector and explore underserved markets. Finally, we also need to foster the traditional role of the civil society to promote change. So in sum, you could say that by providing remittances, the families with better opportunities and more options to use their money productively, resourcefulness of 1 billion people on Earth who either send or receive remittances can contribute to the scope and scale of the SDGs. And that is, for me, the main point we need to focus on. So the second takeaway is that remittances are critically important to rural and more vulnerable communities, in particular in times of crisis, because no matter how many people leave home, more remain behind. Almost half of all remittance flows goes to rural areas, accounting for over $200 billion annually. The current crisis has taught us that the remittances are a lifeline not only for families in fragile or conflict-affected situations, but also for the millions of families living in the low and lower middle income countries. Through the remittances, through savings and through investments, and in the best case, the 3 of them combined, migrant workers possess the power to improve their own lives and the lives of their relatives back home. And governments can substantially increase the positive impact of remittances if they put an enabling environment in place, in particular in the poorest and most remote rural areas. We can leverage the contribution to development. The pandemic, COVID, has resulted in millions of migrant workers returning home. Helping them to build assets and invest in incoming generating opportunities on their return should also be a central development policy objective. I have a third takeaway. That is, while remittances are private financial transactions, their input can only be magnified in concert with coherent public policies and priorities. And it needs to be coupled with civil society and private sector initiatives. That is why strengthening partnerships with key stakeholders in country and around the world is central to our IFAD initiatives, because we are very active in the field of fostering remittances. We can achieve faster, cheaper, and safer transfers by continuing to enhance the environment of remittance flows. We can do this through greater transparency and more competition, and also through engaging with the private sector to bring services and innovations to the farthest places at the lowest costs. I've just seen in the Q&A a question from Mali. How can we do it in Mali? Yes, it's a cumbersome business to reach the most remote areas in fragile countries, but we need to do this. We also need to continue to mainstream financial and digital literacy programs for senders and recipients alike to maximize the impact of the remittances. IFAD has supported migrant workers and their families back home in more than 50 countries now for more than a decade. We have worked to maximize the impact of migrants' investments and remittances to improve the quality of life, to foster financial inclusion, to foster gender equality, and to provide more opportunities for the young people, for the youth. All of this has resulted in enhanced local economic development. We have a long-standing partnership with the European Commission, with Luxembourg, with Spain, with Sweden, and that has allowed us to test different models to achieve these objectives. We have worked with mobile money operators and linked remittances to insurance products to cover thousands of loved ones back home in Uganda. The business model was successful. It's now being replicated and scaled up with insurance companies in several major recipient countries, including the Philippines. We have linked e-wallets to savings and credit products for remittance senders in Malaysia, supporting families in Pakistan and Bangladesh, while projects that promoted emergency savings products, such in the Philippines and Nepal, have literally saved the lives of many people who lost their main source of income. In Moldova, IFAD supported the development of financial products linked to remittances to cover agricultural inputs during the most difficult times of the pandemic. And all these models work. We continue to witness increased resilience and higher economic activities in the communities with remittances initiatives. And we strongly believe that replicating, scaling up these initiatives can spearhead the transformation of food systems while addressing the needs of migrants and their families. At IFAD, we also support migrant contributions beyond remittances. For example, our diaspora investment mechanisms have benefited thousands of rural communities in Africa. We allow them to sustain economic activities, in particular for women and youth. We create viable and attractive options at home. And if we are successful in doing so, people are less compelled to migrate in search of work. There's also less urbanization if you can give people a perspective in the rural areas. By linking investment opportunities in agriculture with diaspora savings, we have demonstrated an effective way to spur development by investing back home. In Mali, I mentioned it already, we have created a crowdfunding mechanism for the Malian diaspora in Europe to invest in their home country. Through this platform, over 500 youth entrepreneurs back home have been supported to set up their small businesses. So, dear colleagues, ladies and gentlemen, in response to the call for solidarity from the Secretary General Guterres over a year ago, the international community came together in support of remittance families. As a result, several international organizations and member states launched dedicated actions to help mitigate the impact of the pandemic on remittance families. IFAD actively created the Remittance Community Task Force, or RCTF. With key stakeholders, we worked extremely hard to maintain remittances to the rural areas of the developing world, while improving at the same time the resilience of those sending and receiving them. A lot was learned, and we are pleased today to see that the UN, along with public, private, and civil stakeholders, has delivered as one. From our end, we are now implementing the measures that were identified by the RCTF in favor of remittance families and the communities where they live. In the coming month, we will be introducing over a dozen innovative solutions in 7 African countries: Morocco, Senegal, the Gambia, Ghana, Uganda, Kenya, South Africa, with key private sector stakeholders to provide cheaper and inclusive digital remittances services in rural areas. This will bring us closer to achieving the SDG target 10C, which says that we are supposed to reduce to less than 3% the transaction costs of migrant remittances and eliminate remittance corridors with costs higher than 5%. So let me conclude this 2021 forum by thanking each of you for your enthusiasm and engagement. These global forums, for me, are essential for exchanging ideas, finding innovations, addressing challenges, and creating partnerships to support the 1 billion people involved in the family remittances. IFAD and its partners look forward to meeting next year in Africa, hopefully in person in 2022, to assess our progress and further promote sustainable development through migrant remittances and diaspora investment. I hope we will all leave this meeting yesterday and today with a renewed commitment to help remittance families improve their lives and to further leverage the impact of these remittance flows to create more economic opportunities, to enable the communities to recover, in particular from the current COVID crisis, but also to be back on track for the SDGs, where already before COVID, in particular on hunger and poverty, we were a bit off track. We know we can achieve this. We can be more effective, we can be more sustainable, and we have to do it one family at a time, I think. Many thanks for your attention and many thanks for your participation. All the best and see you next year. Back to you, Pedro.
Mr. Vice President, thank you so much for summing it all up so well and sharing some of IFAD activities and plan of work. So really, I want to leave it there. I don't want to add. Thank you so much. And I would like to thank all the participants that have been following us through Zoom, through UNTV as well, for the tremendous contributions that we've received. And to let everybody know that the summaries of the exchanges that we had today will soon be posted on the GFRID as well on the International Day of Family Remittances page. So with this, I don't need to say safe travels because we're all in the community of our home, but it is a pleasure and we hope to see you next year in person. Thank you so much to everyone.
Thank you. Thank you. Thank you, Pedro.